Welcome to the semi-annual review of economic conditions and the investment markets with WheelerFrost Wealth Managers. This slide is a summary of our overall position on the global economy, the U.S. economy, and so forth, as well as the fixed income and equity markets. As a brief overview, to generalize, we would say that the global conditions economically are positive, but showing increasing signs of stress. What that means is we anticipate a slowing growth rate globally in 2016 that is primarily centered in China and the slowdown that is being experienced there and the collateral damage that it does to other emerging markets as well as developed markets. In the investment markets, we see equities as being relatively overvalued in the U.S., which implies lower returns going forward than historical norms. We think valuations are better outside of the U.S., particularly in the emerging markets. However, in the short term, there's still a lot of stress there, again, because of the Chinese situation. Fixed income markets are not particularly attractive. Yields are low, which would imply, again, lower returns going forward than we've experienced historically. And we would also suggest that those returns are going to be marginally above inflation going forward. The economic environment, as I mentioned, continued sluggish global growth. The U.S. has been stronger than the rest of the developed world, but the strength in the dollar and weak oil prices have conspired to be problematic for the U.S., and particularly in certain sectors that are either energy related or export related, where the strong dollar hinders the results. Europe has been experiencing accelerating but very slow economic growth and extremely low inflation. As I mentioned, emerging countries' economies are generally growing faster than the rest of the world. However, they are slowing, and that's again primarily based in China. Global inflation continues to be extremely low. It is higher in the emerging world than in the developed world, but we do not see inflation as being a concern, at least over the next 6 to 18 months. Statistically, you can see that global GDP growth in 2014 was 3.4%, expected by the International Monetary Fund to be 3.1% in 2015 and 3.6% in 2016. I've also included a column where we're highlighting, or summarizing, I should say, the leading indicator as provided by the Organization for Economic Cooperation and Development. This indicator basically has a status of neutral, where you would expect trend growth internationally, and it is currently declining. So the way the indicator works is it has a normal reading, which indicates trend growth for the country or for a region, but that indicator can be rising or falling on a monthly basis. So I've identified here whether it reads neutral or positive or negative, and whether the trend is up or down, essentially. In the U.S., for example, you can see that the indicator is actually negative currently and has been declining. The Euro area is positive and rising. China, negative and declining, and Japan, neutral and declining. So you can see summarized here that, generally speaking, we expect stronger growth in the emerging world than in the developed world, and that inflation, as you can see in the inflation column there, in the developed world is expected, has only been 1.8% over the last 12 months. It's been higher in the emerging world at 5.2. The U.S. has experienced exactly zero change in the consumer price index over the last 12 months. And Europe is experiencing essentially zero inflation as well. Some of the sub-indicators that we look at to kind of verify the strength or weakness in those leading indicators, and some of the main indicators that we look at are summarized here by the World Bank. I want to highlight chart B in the upper right that shows the Manufacturing Purchasing Managers Index for the developed countries and the emerging countries. And you can see here that this indicator, which is a diffusion indicator basically, where anything above 50 indicates expansion in the manufacturing sectors of those countries, and anything below 50 indicates contraction in the manufacturing sectors. You can see that the high income countries or the developed nations are marginally positive at around 52, and that the developing nations are negative at around 48. So again, that just highlights the fact that the emerging countries, at least over the last 12 months or so, and we think going out maybe over the next 12 months, are going through a little bit of a rough patch, but it really implies a slowing of growth as opposed to a negative growth pattern. The other thing I want to highlight is the global trade, which you can see in chart F in the lower right. For example, you can see on a worldwide basis that import growth was growing at around 5% per year from 2000 to 2008 worldwide, slowed to around 2.5% since 2010, and in the first half of 2015 was actually negative at about a negative 5%. The emerging economies again show greater growth from 2000 to 2008, and also the slowing pattern since 2010, and a significant slowing pattern in 2015. Also, you can see that global inflation is currently well below 2% in chart C. In the US, one of the things I wanted to highlight was this concept of slowing or tame economic growth, as we would foresee, of about 1 to 3% per year in real economic growth for several years. And one of the main reasons, besides the concept of paying down debt and trying to reduce deficits here in the US, is a demographic issue. And the key here is that in any country, to have real economic growth, you need to have a growth in the labor force, and you need to have a growing productivity of that labor force. So the highlights here really are that if you look on the right-hand side of this, the right panel here, you can see that the drivers of GDP growth, the average year-over-year percent change for the growth in workers, as well as the growth in real output per worker, which is a measure of productivity. For example, you can see that between 1955 and 1964, there was about a 1.5% growth rate in the workforce and about a 2.3% annual growth rate in productivity, which resulted in real GDP growth during that time period of 3.8%. From 2005 to 2014, by contrast, you can see that there was only a 0.5 percentage point increase in the labor force each year, and productivity growth was only 1% per year over that time period, so that we had a 1.5% real GDP growth over that 10-year period. Now, in the upper left panel, you can see that the forecast for the growth in the working age population over the next 10 years is only 0.4%. So if we duplicated our results from productivity over the next 10 years, we would only see a 1.4% growth rate in real GDP. So obviously the key here is that we need to see increasing productivity in order to boost that GDP growth rate. There's really been three key macro factors that have been driving financial markets this year. One is Federal Reserve policy and guesses about what the Fed will do in terms of raising the Fed funds rate or the policy rate. The other is the sluggish global economic growth, specifically in China. And the third is the collapse in commodity prices since last year, specifically oil and natural gas. So, addressing Federal Reserve policy, the Fed has really been hampered in its desire to normalize monetary policy, that is, to raise the Fed funds rate up to a rate that would eventually be considered normal. One is the slowing global economic growth. Its concern here is obviously that if it were to raise rates too soon, it might choke off growth in the U.S. and also globally. The other is low inflation here in the U.S. It's with inflation basically running at zero, there's very little historical precedent for the Fed to be raising rates. The other is dollar strength. The Fed we've already seen the results of a strong dollar and how that hurts our exports. The Fed is concerned that if it was raising rates in a world where most of the other central banks are in fact lowering rates, that it would increase the pressure on the dollar. And the last one is falling commodity prices. The Fed is concerned that by raising rates and maybe slowing growth, it would continue to weigh on oil prices, which weighs on, again, earnings in certain sectors in the U.S. But also falling commodity prices imply that maybe growth around the world is weaker than maybe the numbers suggest. So it doesn't want to be raising interest rates and tightening policy in an environment where growth is slow and maybe slowing more. So a couple key points on this chart. Fed funds rate has been targeted at 0 to 0.25% since December of 2008 in the heart of the financial crisis. They've been talking for well over a year about the possibility of raising rates. You can see in this chart the little internal box there, the Fed's official forecast where they believe inflation is going to be and economic growth will be over the long run. And you can also see in the blue there the Fed's official projections from their committee notes where they believe the Fed funds rate will be forecasted into the future, and the brown dotted line is the market's forecast based on futures prices where the market believes that rates will be. So you can see that investors do not believe the Fed will raise rates as quickly and at as a rapid pace as the Fed has projected. Speaking about inflation specifically, you can see on this chart that the 50-year average CPI inflation has been 4.2%. And as I mentioned, this chart only goes through August, and it was at 0.2. Actually, the September number was exactly 0. The other thing to point out is that there are other measures of inflation, and those other measures tend to be running at an even slower pace. Core CPI, actually a little bit higher at 1.8 because of it factors out energy prices and food prices, and the rate on the core has been a little bit higher. Headline personal consumption expenditures only 0.3, and then the Fed's favorite measure, which is core personal consumption expenditures at 1.3. The Fed specifically has a target of 2% for inflation. It would like to see inflation at that level, and therefore when it's running below 2, it doesn't provide a catalyst for the Fed to be raising rates. Another interesting concept is the fact that even though the Fed has not actually tightened monetary policy by raising the Fed funds rate, it has talked about it for some time. And because it's been talking about it, the market to some degree has done the Fed's job for it. And what I mean by that are the market prices have tended to adjust in advance of the Fed actually raising rates. This chart highlights 3 measures of that. On the left-hand side, you can see something called the shadow Fed funds rate, which is a concept developed by some academics that basically attempts to look at historical yields in the Treasury market and in other credit markets and determined what the Fed funds rate would have been if it was able to be less than zero. The Fed is actually bound by what's called the zero boundary, so it can't actually lower the Fed funds rate below zero. But given the way the market was pricing in other types of credit, the Fed funds rate theoretically would have been below zero beginning back in the financial crisis, and has recently started to turn up, as you can see. Another way to measure that is to look at high yield bond spreads in the middle chart. You can see how they've widened out during 2015, indicating that at least in the high yield market, which are the most credit stressed companies in the investment world, investors are demanding higher prices there in anticipation of higher rates elsewhere. Also, you can see the U.S. dollar, as I mentioned, has strengthened considerably this year, which also is a way of tightening conditions, because with a stronger dollar, it makes our exports more expensive for other countries. It tends to slow down growth here, so it has the effect of slowing growth. Two other quick ways of looking at that. The various Federal Reserve banks in the United States have various measures of financial stress. The St. Louis Fed and the Kansas City Fed both have financial stress indexes, and these are measures of tightness in credit conditions and credit markets in the United States. And as you can see, both of those have turned up in 2015. They're still in a relative easing mode, but they have been getting tighter, despite the fact that the Fed itself has not tightened policy. Also, I wanted to point out the fact that the Fed has been talking about raising rates, but they're virtually the only bank other than the UK in the world that's talking about tightening conditions. As you can see on the left-hand side there, more central banks in the United States are actually easing policy rather than tightening. More central banks in the world are actually easing policy rather than tightening policy. And on the upper right-hand panel, you can see that other than the UK, the other large economies, Japan and the Eurozone, aren't anticipated to raise rates until sometime in 2017. So again, it's a conundrum for the Fed to want to be raising rates or tightening policy when most of the rest of the world is actually easing policy. So now let's talk about China specifically. China's official economic growth rate has slowed considerably. It was running as high as 14.2% in 2007. It was 6.9% year over year in the third quarter of 2015. That's in real terms or after inflation terms. The Chinese government's official target for real GDP growth is 7%. They have usually come in very close to that, and there's usually some doubts by private economists as to whether or not those numbers are valid. Many outside observers believe that the Chinese economy may in fact be growing at something closer to 4 to 4.5% after inflation. China has specifically been trying to steer their economy away from heavier industry, construction, and exports, and more towards a consumer-based economy. And that, they hope, will smooth out economic growth, obviously, but it will also have the effect of slowing economic growth going forward. The result of that is you really have a two-speed economy in China. Many of the regions that were focused on construction or industrial production may in fact be in recession, whereas some of the other regions, some of the more urban areas that have more of a service-oriented economy, are growing quite strongly. This is just a chart kind of highlighting the fact that the consumer sector has in fact been growing in importance. You can see that on the left-hand side, where the gray portion of the vertical bars you can see has grown in the first part of 2015 compared to what it's been over the last few years. The investment section has shrunk considerably, where right after the financial crisis, when China was pouring a lot of money into construction of apartment buildings and so forth, you can see it was 8.1% growth in 2009. It was only 1.2% in the first quarter of 2015. Also, other indicators of the fact that the Chinese economy may be slowing more than the published numbers. You can see 4 areas here: domestic car sales, construction of private residential floor space, all down dramatically from 2014. You can see in the lower right that exports and imports are also down dramatically so far in 2015. And again, the purchasing managers indexes, which attempt to get an idea of whether the manufacturing sectors are growing or contracting and the service sectors are growing and contracting. You can see that the manufacturing sector at 47.2 is in contraction mode, and the services sector is at least marginally in expansion mode at 50.5. And this is just a chart indicating the change in the makeup of the Chinese economy over the years. You can see that the dark line is the service industry, the gray line is the manufacturing and construction industry, and the dotted line is agriculture. And you can see the substantial growth in both the service and manufacturing and construction, but that the service sectors have actually overtaken the manufacturing and construction sectors in recent years. Commodities. Commodities is another area that has been very much of concern for investors in 2015. Slowing global demand for virtually all commodities, and that slowing of demand has come particularly from China, has had an outsized effect on prices of everything from oil and gas to agricultural commodities. Another factor that's had an outsized effect on the oil industry has been the production of U.S. shale oil, which seems to have peaked in the spring of 2015 and but its substantial growth there contributed to a significant portion of that price decline. This chart highlights the significant declines in commodities that we've seen during the year. On the left-hand side, you can see the price range over the last 10 years of various commodities, beginning with the Bloomberg Commodity Index, and then the diamond indicates where it is today. And this is presented in terms of z-scores, which, if you remember your statistics, are really just a measure of variation around the average. So a -2 indicates that it's 2 standard deviations below the norm, and you can see that's a pretty wide, significant decline in virtually all of the commodities other than gold. On the right-hand side, you can see gold prices specifically, and then on the lower right-hand side, you can see how commodity prices and inflation are related. So again, with the Fed having target of specifically 2% inflation rate, and with commodity prices down, it has been putting downward pressure on inflation rates, and therefore has really kind of helped to stay the Fed's hand in terms of raising rates. Looking at energy specifically, the highlight here is really in the upper left, where you can see production numbers for 2013, 2014, and estimated for 2015 and 2016. And you can also see consumption numbers for those years. So the key point here is that beginning in 2014, primarily because of growth of production in the United States, that global production started to grow faster than global consumption. Now, consumption has not shrunk, but growth rates have declined, and combine that with the increase in growth rate in production, um, you see why the price of oil and price of natural gas have declined substantially. This slide just illustrates the enormous impact that the decline in commodity prices has had on certain countries. So the idea here is that a country like Mexico, for example, that depends on oil exports for a large amount of its government revenue, you can see 33% of it is dependent upon resource revenue. And when you have a large decline in those resources, in Mexico's case, specifically oil, it can have a big effect on the government's ability to fund itself. Looking to capital markets, the stock and bond markets particularly, you can see that our expectations are for subdued stock and bond returns over the next 5 years. Stock market returns are likely to be in the range of 6% to 8% per year, with foreign markets, particularly emerging markets, having greater potential. Bond returns are fairly accurately reflected in the current yields to maturity that you see in the bond market. And in investment grade bonds, those are primarily in the 1% to 3% range. High yield bonds are higher, obviously, with added risk, and emerging market bonds have the potential to return a higher return over the next several years. Commodity prices, as I pointed out, are depressed and have the potential, should things turn around, to provide meaningfully higher returns going forward. One of the things I wanted to talk about in terms of the bond market was the concept of foreign ownership of treasuries. I often get asked, what will happen if foreigners who at one point a few years ago owned in excess of 60% of the treasury market, currently it's more like 43 or 45% of the treasury market. What if they started to sell our bonds? Wouldn't that, with the implication that it would be something tragic, that is that if China started to sell treasury bonds, that it would result in the dollar declining dramatically, interest rates going up dramatically, and the economy suffering. Well, the reality is that China has been a big seller of bonds so far this year. And in fact, this chart, which indicates net foreign official purchases of U.S. Treasury notes and bonds, net foreign official purchases is a euphemism for central banks around the world, have in fact been net sellers of Treasury bonds and notes so far in 2015. There's a variety of reasons for that. It's been led by China. China has really had to sell Treasury bonds in order to keep their currency stocks up to where they want them to be. There's been a huge outflow unofficially of currency from China. There are restrictions on what individuals can take out of China, but those restrictions have not necessarily been effective, and they've seen a huge outflow of currency from the country, and China has really been forced to sell some bonds in order to replenish that. But the reality is that yields in the bond market in the U.S. in Treasury bonds and investment grade bonds have really been range bound. The 10-year Treasury note is currently at about the same level where it was at the beginning of the year. So the reality is that this rather large amount of selling that has taken place hasn't really had much of an effect on interest rates in the U.S. As you can see, the returns so far in 2015, and this chart goes through the end of the end of September. The returns in the bond market have been unexciting. The 10-year benchmark 10-year Treasury has returned 2.39% so far in 2015. The aggregate bond index in the U.S. has returned 1.13%. So again, returns have not been exciting in the bond world. Globally, you can see that again on the right hand, the left hand panel and the right hand column, you can see the U.S. dollar return. You can see that 1.13% for the broad U.S. market. Now, the interesting thing when you start looking at global returns is that the returns to a dollar-based investor have been hampered by the dollar strength. For example, if you look at the line for Italy, you can see that the year-to-date return has been 2.98% for an Italian living in Italy, getting their return in euros. However, for a U.S. investor, once those euro returns are converted into dollars, which we spend, the return is a negative 5%. So that dollar strength has hurt U.S. Investors in the global bond markets. Also in equity markets around the world, you can see that in 2015 that the S&P 500 through September was down 5.3%. That was largely made up so far in October. The EFA index, the Europe, Australia, and Far East index, which is one of the major indices reflecting developed markets around the world, was down 0.6% priced in those markets' local currencies, but again was down 4.9% for a dollar-based investor because of the strength in the dollar. If you look at the emerging market line, you see where the real pain has been. Emerging markets again have suffered because of a slowing growth rate, though not a negative growth rate in their economies, but a slowing growth rate. Down 6.9% in local currency terms, but down 15.2% in US dollar terms. One of the things I like to point out to kind of help illustrate the point of valuation in the US is to compare the current situation with the way the market looked back in March of 2009, basically at the bear market trough in the financial crisis. I keep these stats on a weekly basis, so all of these are basically as of week ending, that is Friday's close, not necessarily the actual lowest level or the actual highest level in the market, but the statistics as of that Friday of that week. So, for example, the S&P 500, the week ending 3/6/09, was at 638 and change. The dividend yield was 3.6%. The trailing 12-month earnings on the index was $49.04. The price to earnings ratio, or the PE ratio at that time on those earnings, was 13.9. Compare that with the recent peak in the market in May, and you can see that the dividend yield had gone from 3.6% down to 2%. Earnings had obviously gone up dramatically from the financial crisis, up to $111.50 on the index. But prices had also gone up substantially, such that the PE ratio on those earnings was 19.1. You can see that currently the PE is at 19.4 and that earnings have actually declined. Again, that's primarily the result of the energy sector in the economy and in the S&P 500, which is reflected in the fact that earnings there have gone down enough to draw down earnings for the entire constituents of the index. Another way that we really like to look at earnings is to look at the concept of normalized earnings, and this smooths out some of those peaks and troughs and the volatility of earnings that we see throughout the business cycle. You can see that back at the market bottom, normalized earnings on the S&P 500 were about $64 a share, and it was trading at about 10.6 times those earnings. And that put it in the second decile according to the Luthold Group, going back to 1957. In other words, it was in the lowest 20% of all readings going back to 1957. Obviously a good value. At the market peak in May, those earnings had grown dramatically, but the PE had also grown up to 21.7, and in fact it was in the ninth decile, or the top 10% of all readings going back to 1957. So the contrast here is that you have an extremely attractive market from a valuation standpoint back in March of 09, and you have a much less attractive market in May of this year and currently in October, where it's in the eighth decile, or the highest 20% of readings. Here at WheelerFrost, we engage in some forecasts of where we think the stock market can or what it can do over a 5-year period into the future, and that's based primarily on consensus earnings forecasts for the companies in the stock market, as well as where the price is today and where it might go in the future, and what dividend yields are. And as you can see, that at that time, at the market bottom, we had forecast a 5-year return, total return, including dividends and capital gains on the S&P 500 over the next 5 years of 13% per year. Now, in reality, the market did far better than that, doing in excess of 20% per year over the 5 years from the bottom of the market. Currently, you see that we forecast a 7% return over the next 5 years, and again, that is an estimate based on current valuations, normal earnings growth, as well as the dividend that we have today of about 2%. So obviously the market is less attractive today than it was at the market bottom, and that feeds into our forecast of basically 6 to 8% range. And I would think of it in terms of a range. You know, no one can forecast with certainty, but you know, we think that something that to plan on something between 6 and 8% is a reasonable number. Just to highlight the valuation case with some pictures, you can see up on the upper right, again, courtesy of the Leuthold Group, this concept of the S&P 500 price to earnings ratio on normalized earnings. And you can see the 1957 to date median is 18.8, whereas we're currently in excess of 19. And the longer term, back to 1926, the median is 16.8 times earnings, and again, we're at 19. So our view is simply the fact that it's fairly obvious that PE ratios ebb and flow and revert to the mean, and we feel that when we're at ratios that are higher than average, that they will eventually revert back towards average. And that is factored into that 7% expected return going forward. Another important concept in estimating stock returns, besides valuation, is how fast earnings will grow. And an important factor in how fast earnings can grow are profit margins. So this chart is highlighting the profit margins on U.S. corporations in the U.S. economy. Now, this is not just Standard & Poor's constituents. This is corporate profits across the entire U.S. economy. And profit margins are measured here as a percentage of GDP, along with two moving averages and a long-term median. So the point here is that profit margins in the U.S. peaked at about 10.1%. Now these are net profit margins, that is after tax. And you can see it peaked at about 10.1% and have declined to about 8.6% as of the second quarter of this year. The 5-year moving average, you can see, is the blue line there. The 10-year moving average is the red line, which is about where we are. And the long-term median is about 6%. So the question here is, again, as the economic cycle ebbs and flows, and we're coming off of a peak profit margin of about 10.1%, where will it normalize at? Will it fall as far as the long-term median of 6%? Will it fall through 6%? As you can see, it often does. We're not really in the camp that we think that it will fall as low as 6%, but it's clear that profit margins could fall further, which would inhibit growth in earnings over the forecasted horizon of the next 5 years. If we have slower growth than anticipated, obviously the expected return would be lower than anticipated. Shifting gears a little bit and looking at valuations outside of the U.S., as I alluded to earlier, we think valuations internationally are a little bit better than they are in the U.S. These charts are again from the Leuthold Group, and you can see the PE ratio on normalized earnings for the developed world, ex-USA or outside of the U.S. up in the upper right, and you can see that profit margins there, rather than being above average, are slightly below average. On the lower left-hand chart, you can see a comparison of the U.S. PE ratio versus the foreign PE ratio, and you can see that that relative valuation is also on the high side. That is, our valuations are higher than they normally are relative to other developed countries. And on this page, we can highlight the emerging world. Again, in the upper right, you're looking at normalized profit margins in emerging markets. And again, rather than having PE ratios higher than average, they're actually lower than the median. Now, the history does not go back nearly as far in the developed world or the emerging countries as it does in the U.S., but you can also look at the absolute numbers. Whereas the U.S. was trading at a PE ratio of in excess of 19, you can see in the emerging countries the PE ratio is actually slightly less than 10. So on both an absolute basis and a relative basis, you can see that there's much higher potential because of that lower valuation. On this chart, we take a more detailed look at that concept of valuation and what that means going forward. So on the left-hand side, you can see PE ratios compared to the next 12-month return on the S&P 500. And this is a scatter diagram that basically points out the fact that the relationship is not very tight. That is, over shorter periods of time, and 1-year horizons are short periods in the investment world, you can see that the R squared, or the relationship of the PE ratio versus its 12-month return, is only 9%, indicating that that only about 9% of the 12-month return can be attributed to the price paid at the beginning of the period. So there's a lot of other factors that will factor into what you receive in return over a 12-month period. How fast are earnings growing over that time period? What is the general investor sentiment? What's going on politically? There's just a range of factors that can influence returns over that shorter time period. On the right-hand side, you can see by contrast that when you stretch the horizon out to 5 years, that the R squared is much tighter, and you can see on the graph that the relationship is much tighter. If you buy at low PEs, as reflected on the horizontal axis, I should say, and you tend to get higher returns as reflected on the vertical axis. And in fact, the R squared is 43% here, meaning that 43% of your subsequent 5-year return can be attributed to, or statistically attributed to, the valuation that you paid at the beginning of the period. Now again, the returns are going to be subject to how fast earnings grow over the time period, how fast dividends grow over the time period, and what the valuation is at the end of the time period. But nonetheless, the fact that nearly half of your return can be determined based on the price you pay at the beginning of the period is meaningful. And that plays a big role in our forecast of what returns will be over the next 5 years, with valuations higher than normal, with earnings likely to slow from what they've been growing at over the last 5 years, and with dividends at 2% as opposed to a historical average closer to 4%. You can see why we forecast returns in the 6 to 8% range instead of the long-term widely publicized S&P 500 annual return of around 10%. One area that we think has attractive attributes, if you look out again over that 3-5 year period or longer, is the energy sector. Oil prices, as we talked about, have declined dramatically. But we know that oil prices tend to fluctuate dramatically. On this chart, you can see that on the right-hand side, that the energy sector of the S&P 500 has underperformed the broad index rather dramatically. And on the left-hand side, you can see a measurement of valuation on the energy stocks. Specifically, we're looking at price-to-book ratios going back to 1952. Price-to-book can be a little bit better measurement for the energy sector because of that extreme volatility of earnings, but the book values tend to be more stable. So you can see that the price-to-book ratio has tended to bottom at about 0.6 and tended to peak usually around 1.2. You can see there was a period back in the late 70s, early 80s where it got up to 1.6. But normally the price to book ratios fluctuate between about 0.6 and 1.2, and currently we are at 0.6. So given the fact that you can get dividend yields in excess of 3% in the energy sector, and that it's trading at arguably historically low valuations, implies that the expected returns again over the next 5 years or so probably will be higher, or have the potential to be quite a bit higher than the broad stock market. Another factor as to why we believe that the energy sector may be an attractive place to begin investing excess funds into is that oil prices really need to be higher in order for much of the world to, for the governments of much of the world to function effectively. This chart is looking at the break-even oil prices per barrel estimated that would be needed in order to balance the budgets in some of these oil-producing nations. For example, Saudi Arabia would require oil prices per barrel to be above $100 per barrel, where currently they're in the mid-40s, in order to balance the books. So we believe that eventually, whether it's because production slows down in the U.S. because many of the shale producers can't produce oil profitably at a mid-$40 per barrel price range, or because once production slows here in the U.S. that OPEC also slows production. There's a myriad of different scenarios that one can draw up, but we believe that oil prices will in fact head higher at some point. They may not get to $100 a barrel, but they don't need to provide profits for an investment in the energy sector. In fact, probably you would see prices in the 60 to 80 barrel range, maybe going out over the next 18 to 24 months would not be an unreasonable assumption. So finally, to sum up, we believe that overall conditions favor stocks over bonds. In the U.S., stretched valuations and possibly slowing profit growth in the context of a mature economic expansion would seem to suggest that returns going forward will be lower than they have been over the last 5 or 6 years, and certainly slower than the historical norm. International equity valuations are more attractive, particularly in the emerging markets, but again, over the short term, it's anybody's guess as to the return pattern because of that slowing economic environment. But the valuations and the higher potential growth in those areas would argue for a meaningful allocation in anticipation of higher returns over the next 5 years. And again, in the energy sector, kind of a similar story with energy prices so low and having declined so much over the last 12 months that it seems prudent to anticipate that you would see some normalization and some reversion to the mean there, where you'd see prices go increase and returns in that sector would seem to have the potential to be higher than the broad market. Finally, I'd like to thank you for your attention and encourage you to give a call to WheelerFrost if you have any questions.